Hi, welcome to Quantitative Investment. Today, I want to share something I found that worries me that the long-term yield may rise. So, my motivation again is that the long-term yield, such as a 10-year, 30, 20, their yields are at the 4% level, which is something we might want to hold. But when the yields rise, we will lose money. That's the nature of the bonds, without without the possibility of default. There's still a great risk. So I spent some time studying the risk of the bonds. So I found that the yield curve is really inverted for now, but I'll show you how inverted it is today. How bad? So my argument is when something really bad happens for a while, it'll bounce back. It'll become good for a little while. That's what we call rebound, right? So when something is really good for a while, it'll become bad for a while, a little bit. That's technical analysis, but that's just when the yield curve is really bad, it'll take the long-term yield to bounce back. So it'll become a little bit normal. That's a technical analysis. So I want to know how bad it is for the yield curve. I figured it out all the time since 2000, that when the yield curves were inverted. Then there are a few instances. 2023 is right now. If we look at the yield curve, it is inverted. And the difference between the 1 month yield and the 30-year one is 1.27%. 2019, difference is 0 to 7%. Still inverted. 2007, yield curve inverted. 1 month and the 30-year yield difference is 0.44%. 2000, yield really inverted. Difference 0.53%. Accounting for all the instances, it's shocking that the yield curve is the most inverted for right now, for 20 years, more than 20 years. All the instances have the one similarity that they're all at the end of the rate hikes. So I don't want to conclude that the rate hikes will definitely almost cause the yield curve to invert it. But if that's the case, if that's the norm for what happened when the Fed starts to hike rates, I'll feel a little bit more comfortable because I will see this as a normal thing. How bad? Okay, I figured it out. 70 years of data since 1950 till now. Only 3 times that the yield curve were more inverted than now. So I chose 3 yields: the 30-year, 20-year, and the 1 year. The red, the green, the 30, 20-year yields represent the long-term yield, while the blue one, the 1 year yield, is the short one. We want to see the blue one below the others because that means this is normal. So now the blue one is higher than the others. So if we trace back in time, we see 2021, first half of the year normal, and then 2014, 11, I believe that's when the rate is almost 0. But the one thing that is what we want to see is the more it is away down, it is better because investors are expecting the long-term yield to be higher than the short-term because freely with no risk. So you imagine like a 30-year yield is no risk from stock market. So you want higher return investing long with no risk. That's a good thing. So if we move back up until 1990, somewhere here, do we see something worse than what it is right now? The blue one is far higher than the others, such as this, like what is right now. So if we move back to 1970, somewhere around here. It happened again. 1958 to 1960. I don't think this one is higher than what it is ours. So the yield curve is really badly inverted. Implications. So assuming there are three scenarios that are going to happen, the yield curve becomes more inverted. This could happen. I believe this happened a few days ago, or just happened yesterday in August 10th, yesterday. So it happened shortly that the July PCE was announced. So the 10-year Treasury yield dropped below 4% for a little while, and it's back. When it did, it actually meant the yield curve was actually inverted worse for a while. When that happened, we may earn some money from the price gain of the bond. Number two, the yield curve becomes less inverted. That's what I worry. So picture if I want a 4% yield bonds, but it is increasing, so I'm losing money, maybe a lot of money in long-term bonds. 10-20% it could be. I don't want to see it 20-30% loss in my bond position. So number three, the yield curve maintains. Nothing happens, you don't lose, you don't gain. So again, my argument today is the yield curve is really inverted, really bad. So if it bounces back, the long-term yield increases. We will lose money holding the long-term bonds for a lot. So short-term bonds, for short-term bonds, the duration is shorter, so we don't worry too much. But if the Fed starts lowering the Fed funds rate, this could not be a problem. Nothing I talked about today will be an issue, because the yield curve will just become normal without the long-term yields to increase. Thank you for watching. Bye bye.